Hey everybody, welcome to Housing Bubble 2.0 News of the Week. I am Randy Patrick, your host and information supplier here. Like always, a busy week in housing and real estate news. So much is going on, it's hard to keep up. A little sorry for delay in posting the video. I actually had a fiber cut outside my house and we're dealing with that for the past couple of weeks, and today they actually came to remove the temporary solution and actually sort of dig the cable stuff back in the ground, and it's taken longer than they said, so I've been kind of offline here, which is unfortunate. But was doing some stuff off my phone, and before I guess my concern now is that if I wait too long, I miss out on news. So just checked the internet or the news wires to see what was going on before I made the video, picked up another little piece of news that's interesting, and we'll start now. Okay, so what's been happening the past week? Well, today we're going to focus on new home sales crash, existing home sales, the values and prices, coastal relocation, and of course mortgage rates and that ever increasing number of delinquencies going on in the marketplace right now. So basically what I want to do is just sort of mention the fact that if you're looking at stuff on the internet and you're reading articles and watching videos, there's been a little bit of a change this week. A lot of people are sort of saying, hey, maybe the situation is not as bad as we thought it was, and maybe things are looking good here. So it's one of those deals where, maybe a small uptick in some number makes people think twice about where we're at in the marketplace. Now, with all the metros across the marketplace and all the different things going on in real estate, there's a lot of factors that contribute to the housing bubble and its imminent, we'll call it crash, crisis, etc., correction, whatever you want to call it. So again, some are suggesting that we're still going to see a 4 to 6% appreciation for the year 2019. So it's like, hey, this is a slowdown. It's a blip in the road here, bump or speed bump, whatever you want to call it, and we're just going to pick up the pace again in the new year. Well, I kind of disagree with that, and I do disagree with that. And the reason I disagree with it, because we've seen this before. And this is exactly what happened, a little over 10 years ago, when people were saying, oh, this is a small correction, 1 or 2 months and we'll get back on track. Well, that didn't really happen. And again, the frothiness, as was told back in the day in the market, led to a major crisis and crash. So all the factors that I guess you could say were happening and contributing to the overall economy issues and the collapse of the housing market are happening again. It's almost a verbatim 1-to-1 ratio as to what happened and it's happening again. There's maybe a couple of little subtle differences and nuances within each factor, but in the end, all the ones that contributed before are contributing again, and that's the way it is. So just realize that, the whole point though is that we don't have crystal balls, so we can't look. Everybody wants to know, well, how far is it going to crash? How much are we going to lose? When is it going to happen? Well, we can't predict that, but what history has told us is that we're positioned for another slowdown, downturn, and a correction in the marketplace. Personally, I think it's not going to be 5 or 10%. That is a blip in the road as far as I'm concerned. I think we're going to see more 25%, 30% across the board. That's what I predict. So again, realize though that's the bubble mentality, is the fact that people, once you're in a bubble, you don't realize you're in a bubble, or part of the security of being in the bubble is you tell yourself, oh, there are signs that show us that this bubble is going to maintain and keep going, so therefore I'm not going to listen and look at all the other factors that are sort of dragging us down. That's kind of what's happening now. So again, a couple little increases in activity do not necessarily equate to a corrected market and a market that's going to appreciate double digits like we had over the past couple of years. It's not going to happen, people. All right. So again, as I mentioned, I've had experience with this. I was participating in real estate, before the housing bubble. I watched it grow. I watched it burst. I watched it and participated from a investor buyer perspective, from a seller perspective, from a real estate broker perspective, and a lot of things that go along with that. So I've seen a lot of carnage and missed opportunity in a housing bubble and a housing crash. And on a personal note, I'm using all that information to my advantage this time round, so that I can, take advantage of what's going on and do well in that marketplace. You may want to do that as well. Okay, so, but the cool thing is hedging your bets. It's better to be educated right now and expect the worst and be pleasantly surprised if we don't have the worst. And there you go. At least you know what you're walking into, as opposed to before when we had no idea as a society. All right, let's talk about new home sales crash here. Well, new home sales plunged to their lowest level in December 2016 for last month. It was a 5.5% crash month over month. August numbers, this is September, so August numbers were revised to be drastically lower than they were reported, and June's and July's were also revised and they were lower as reported as well too. So we have a 13% year-over-year collapse from September this year to September last year for new housing sales. Now, to offset that, new home supply rose to 7.1 months. So typically a healthy market tends to have about 6 months worth of supply. Anything less than 6 months tends to be inventory challenged. Anything more tends to be a buyer's marketplace. So now we kind of have a buyer's marketplace going on right now with the extra supply. This is the highest supply since March of 2011. Now, once again, if you listen to the news and you look at the media stuff, builder stocks are taking a beating on this news that there's less sales and there's more inventory. It's down about 40%. So the stocks across the board down about 40% year to date. But, again, some analysts are saying that don't read too much into this because, again, this is yet another, as I said, little blip in the market, bump in the road, not a big deal here. However, builders can ebb and flow with the market. They can turn on and turn off marketing. They can delay housing starts and permits and things like that. So they do have a lot more control than the retail housing market. But again, this is not looking good, and it boils down to affordability being the number one issue, of course, and the fact that builders are not building affordable homes, and now we have rate increases to make it tougher for people to jump in and purchase these properties. All right, and again, as I mentioned before last week, the thing about home building and in this industry is that there's a trickle-down effect in the economy because builders are employing people, they're buying land, they're putting in facilities and services. You're buying materials to build a house, you're putting finished materials in. A new homeowner is buying things like washers, dryers, appliances, new home furnishings, decorations, the whole bit. So this all adds up to a lot of activity in the economy, which when home building slows down, it does affect a lot more people than just the actual builders themselves. Now, existing home sales, so NAR, which is the National Association of Realtors, stated that pending home sales had a 0.5% increase in September. So, 0.5, so 0.5% of an increase, which is not huge. It's still a year-over-year decline. So, we didn't actually have an increase. Well, we had a slight increase, which again, this is what happens. We had inventory that was being held back that's come on over the past couple of months. So yeah, we're going to see buyers jump in and sort of take up some of that inventory, but we're not talking, that's less than a percent increase. It's not material as far as I'm concerned. The number of pending sales in the marketplace has declined for 9 straight months. So that's less resale homes being sold, less people going into contract. Could mean that buyers are waiting on the sidelines to see what happens with rates, and again, waiting for more inventory to hit to see price reductions. If I'm a buyer, I'm doing that. If I'm renting and I can afford to wait another 4 months, 6 months, maybe a year, I'm not buying a house right now. I want to see how this all kind of hashes out to get a better deal down the road. And again, I'm not even going to get into it today, but there's still more inventory coming on everywhere in the country. West Coast, Midwest, Northeast, Southeast, the whole bit. It's happening. Too much to go into, but if you're looking around and reading all the news articles, every location has more and more home selections, and we're seeing more and more price decrease across the board. Now, Adam Data yesterday released their Q3, so quarter 3 2018 home price appreciation report. Okay, so the U.S. single-family residence and condo sold for a median price of $256,000. That's up 1% from the previous quarter and up 4.8% from a year ago. So again, what's Q3, which would be July, August, September. So that's typically when there's a lot of annual closings and movement going on in the real estate market. So it's to be expected. Obviously, as the fourth quarter and winter months come on, we should see that drop quite a bit. But this was the slowest pace of appreciation since Q2 2016. So we know we peaked sort of in June, July, and we're seeing the effects of that. So okay, we're up 4.8% from a year ago, year to date, but again, we are seeing the slide of appreciation, which eventually will be a plateau, which eventually will be devaluation. So the rate of home appreciation slowed in roughly half the market. So this report looked at 150 markets, and of course in 74 markets, the rate of appreciation slowed. Now, then places like LA, Chicago, Dallas, Fort Worth, Houston, Miami posted single-digit gains. And on the flip side, the other half of the marketplace, had appreciation, didn't slow, and places like Boise, Las Vegas, Lakeland, Florida, Colorado Springs, Dayton, San Francisco, Atlanta, all posting double-digit gains year over year. So, and there's a lot of things going on here, but again, you see that half the market is acting differently than the other half of the market. It's just a matter of time to have, for the appreciating half or the high appreciating half to slow down as well too. And that's the dichotomy of what we deal with in real estate these days. So again, approximately 69% of median home prices in metros were 11% above the pre-bubble / crisis peak back in 2005 and 6. So that, again, that kind of runs right in line with the Case-Shiller home price index that came out a couple months ago. Now, interesting to note, distressed sales were 11% of the market. Distressed sales are auctions, short sales, REOs, things like that. So distressed sales made up 11% of the market, and 21% of the metros posted year-over-year increases in the distressed sales category. So this is where we see things changing, because that number's been much lower over the past couple of years. So if that number is increasing now, we see that this is a few more REOs are coming to the marketplace. That means more foreclosures are happening, more short sales, more auctions, things like that. So I expect the distress number will start to rise as months go on here. Coastal relocation. So Redfin did a migration analysis and found that in Q3 of this year, 25% of the people that relocated moved from high-priced coastal markets to locations inland. So they're leaving San Francisco, Los Angeles, New York, and Washington area, and they're going to Atlanta, Phoenix, Sacramento, etc. Main driving force is affordability is a driving factor. Also, you've got state and local taxes that are also SALT, which we call SALT, having some impact as well too. And that's why places like Boise, Idaho is booming, because they're seeing the effect of people going, I don't want to live in the West Coast and pay those huge prices. I'll come to Boise, where I'm going to get a better quality of life. I'm going to get more bang for my buck as far as my dollar is concerned and home price purchasing power. And also, it's the intangibles, nicer location, less stress. I'm not doing 90 minutes or 2 hours, one-way commute every day. So a lot of people now are getting burnt out on the rat race and saying things have to change for quality of life. So this is what's happening. So again, to be expected, coastal relocation, again, everybody's sort of moving inland. Now, mortgage rates and delinquencies will clearly, mortgage applications continue to weaken from a year ago. Rates are now obviously affecting buying decisions and how people go about placing offers. And what I mean by that is your buying power is less. So I know that it's going to cost me more money on my mortgage, and my down payment is worth less now because of higher interest rates and higher purchase cost affordability. So of course, my monthly is going up, and my loan to value as a percentage of my down payment is getting smaller and smaller. So to do that, they're countering that effect with placing lower offers. And we're slowly seeing, as more inventory comes on, this is moving towards a buyer's market. So sellers are living in the past in some locations across the country, and they need to realize that they can't base their price or their expectations on last year or 6 months ago. Things are different now, and sellers, again, you got to come to the realization, if you don't sell now and take what you can get, chances are you're going to take a lot less in the future if you don't sort of play the game and engage the borrowers and the new buyers. And again, the new buyers want nice houses, and they want all the custom things and the benefits and the upgrades, etc. So that's part of the issue in the marketplace as well too, is that people who are putting their home on that's an average decor home with average upgrades, wanting top dollar, are finding they're not getting that anymore, and they need to reduce the price to show that they don't have those features, and new buyers are wanting those extras in there, and that of course will demand through in the price. Government, Fannie and Freddie continue to back riskier loans. We see subprime still increasing. We see the share of non-bank lending it's called the shadow banking industry, non-banks lending more and more to people who are, we'll call it documentation challenge, lower credit score, credit blemish people, the whole bit. That's still picking up. In other news regarding this, this is from Black Knight Financial Services. They have a first look at September 2018 report. Mortgage delinquencies rose more than 13% in September. This is the single largest month rise in 10 years. So since November of 2008, this is the single largest increase in delinquency, in volume of delinquencies. There you go. Now, so again, that was 10 years ago when the market was really starting to do its crash. Hurricane Florence related delinquencies were up about 38% month to month. I still think it's a bit early. So obviously we're seeing some of that, but depends on where your mortgage payment falls and your due date on your monthly bill. We'll see that number increase as this next month goes on. It will rise as time goes on. They did, however, state that foreclosure starts posted a monthly decline. So that's actual foreclosure filing. So mortgage delinquencies are you're not paying your loan, so you're falling behind, and foreclosure starts are really the lender doing what they need to do to initiate the process to obtain the property back from you because of your default status. So realize that. Now, I know that foreclosure starts do sort of move seasonally, and there was a lot that was filed over the months of sort of June, July, August, and September. So again, this, and I want to say something about Black Knight Financial Services. I find that they, as a data supplier, or at least when they talk about and do press releases across the board, their numbers always tend to be lower and more conservative than other providers of that information. So a little different out there. So I just want to realize that, because things like when we talk about underwater homes, their numbers are always lower than other people who are other groups like Atom Data Solutions, for example, that are working their statistical model. So I guess it's your source, but realize that, hey, I think they're always understating. So if 13%. Delinquencies is probably more. So that's worse for the marketplace, better for those who want to participate in that, I suppose. Now, I don't know about your area, but as I said before in some videos, right here in Florida, we're seeing 50% year-over-year volume increases in most major counties here in Florida. So I have the data. I look at my county here. I do total of 2017, and I'm getting a value. I'm doing, my last poll was year-to-date, which was end of September 2018. So it's already 50% more than it was last year, plus there's still 3 months more to go, which means, again, less filings happen in the fourth quarter, but still filings do happen. So that 50% is probably gonna be more like 60% when the year's done. So I don't know what's happening in your marketplace, maybe something good to investigate, but there's more and more people not paying their mortgage. And again, when you look at these situations, the question people ask is, well, if we've come off high values and peaks and all this great stuff, why do we see increases in foreclosure filings? Well, it's quite interesting. Well, it's called personal economics, okay? There are some loan vintages that have more default rates than others for various reasons, but again, it goes to personal economics. People, even though the job market is reportedly strong and unemployment is low, it doesn't talk about wages, and we know that wages are not increasing. They're increasing at a very low pace. They're certainly not increasing with respect to the pace that housing has appreciated. That's a big issue. And again, people who are working are taking a reduction, going from $100,000 a year job to a $40,000 a year job. They got the same price, the same mortgage. They're having a hard time making ends meet. And also, less hours, more part-time workers, etc. So the job statistics show strength in overall who's working and who's not. But when it comes down to it, your income levels are decreasing as goods and everything else rises. And again, our borrowing power also is less and less as interest rates rise. So all these things affect the marketplace. And funny, as I say that, this is how the market starts to crash. Well, we have multiple bubbles going on right now. So we have a housing bubble, all right? We have a subprime car market bubble, a lot of repossessions and issues happening there. We also have we call this, and this is what I printed out before making this video. We literally have a delinquent, I guess the title says, delinquency is at crisis levels, student loan bubble is about to pop. So basically, of all the debt that's out there, student loan is the most debt, apparently, and that's where there's billions and trillions of dollars they're tied up in student loan debt. And more people are defaulting on their student loans. And especially if your loan is interest-based, because interest rates are going up, guess what? Your payments are more money. It's costing you more money to pay that loan, and people are having problems. So you can read this. It's going to be out there later on today. I'm assuming that. But it boils down to that more and more people are, state that this is the number one barrier to purchasing a home, is the fact that they have to deal with their student debt, or they want to deal with it first before making a major purchase. And this is it's growing more and more. That's the situation we're in. So again, with respect to the housing market and crisis and how things roll out, typically there's a lot of factors involved. There's factors that affect housing directly, and then these are what I call the erroneous factors, things that affect economy and people's personal pocketbook that contribute to whether they're going to pay certain things first and certain things that will lag behind. So we know that things that they pay first are, auto payments, because you got to drive, gas, utilities, food, things like that. Then stuff like student loans and your mortgage payments tend to lag, because people know that they can fall behind on those and roll the dice. So anyway, that's basically it for the news of the week today. So appreciate the views, appreciate the comments. I'd love to see what's going on with where you live in the U.S. here. Also appreciate if you guys would subscribe. I'm going to start doing some more interesting videos as time goes on. I've been pretty much talking about the news and how it relates to, I guess you could say, the marketplace and what's going on in the housing. And I'm going to start adding into the videos more opportunity thought on how you can take advantage of the next housing crisis, what to do, how you can position yourself. And again, the opportunities are there. As someone told me with the last housing crisis, you only get, this was a once in a lifetime opportunity, which back 10 years ago I had to agree with them. But now it looks like we're going to have a second chance at that once in a lifetime opportunity if this all plays out as it's destined to do so. So anyway, appreciate everybody. Looking forward to speaking with you in a couple of days. Thank you.